we had many times where we were told, we couldn't go on a vacation with family or friends. We had food stamps for a time. And so my dad was laid off twice, and they had to dig into their 401k, which wasn't much, and tap into the equity in their home, which was all that they had. And that was also the worst time to dip into it during the crisis. And so I saw and witnessed a lot of these things and wanted more. And so I started reading books like Rich Dad, Poor Dad from Robert Kiyosaki, and Total Money Makeover from Dave Ramsey, and Zig Ziglar books, and Jim Rohn books, and just taught about that there is a better life out there. And so I saved 75% of everything I earned during high school. I set up a brokerage account with my dad at 15 and started putting every portion of my paycheck into stocks and mutual funds to invest for my future, because to me, it wasn't about how much you made. It's about how much you keep, and of how much you keep, how hard you make that work for you. And so when I came to college, I bought a fourplex early, lived in one unit, rented out the other 3 units, and it covered all my expenses. And all of a sudden, I realized I'm now able to put a lot more money away for my future. I just need to buy a few more of these types of properties. And so that became the goal, even though I wasn't real sure yet what I wanted to do for my career. And it set me on a path where I got to about 100 units in my 20s, and started to be invited to a lot of podcasts and conferences as a panelist speaker. And that opened the door for me to start working with investors and bringing in more capital. And I was a financial advisor trying to grow my portfolio. I met a couple of affluent families in our valley here, and was fortunate to work with them and how the wealthy was protecting their wealth, creating a legacy for themselves and for their family. And this gentleman sold a business or portfolio for a $20 million profit, and he didn't pay any taxes on it. And it just blew my mind. After all the things I had studied, I'd never seen a way to shelter that much income. And
that's crazy.
Here I am paying a meaningful amount of taxes, I thought, and someone making so much more money than me wasn't paying a dime. And I thought, wow, this can't be legal, or it's gray. Realized that the government gives us amazing tax incentives and tax credits for providing housing in America, because it's a big problem, affordable housing. And so there's great tax credits and incentives in real estate. And this gentleman was utilizing those amazing tax benefits to shelter his strong income, selling businesses, selling real estate, earning strong wages. And that was, to me, now the secret sauce of how I was going to be able to grow my real estate. And it's helped investors and clients, and helping them navigate the difficult challenges of how to invest their money. Today, we're managing almost $200 million assets under management, $500 million almost in portfolio value of real estate. And that's all starting from a very small place of small properties, and then compounding those with 1031 exchanges, and now working with investors to go into larger deals. And so that's some on me. Bronson, why don't you tell us some more about you?
Man, you're a pro real estate athlete, that's for sure. All right, so Kaufusi, and I played football in the NFL for 7 years, and played college football and basketball at BYU. Graduated in statistics, emphasis in analytics. So I've always loved numbers. And for me, I just didn't know what I didn't know growing up. I didn't grow up with a lot of money and funds to even use the word invest. So yeah. I always heard about it, and so when I got drafted into the NFL and signing my contract and seeing that number, I was just
literally a physical check.
Literally, I took a physical check.
No way.
And I took that check and I put it in my backpack. And I thought to myself,
what am I doing?
Yeah, what am I doing? It's the most money I've ever seen in my entire life. But then, what about like, will Wells Fargo take this? Like, I had no idea, because
Did you have a bank account or anything? Either?
Yeah, I had a bank account, but that was it. And so
just a normal checking account.
Yeah, normal checking account. I had no idea. I actually walked around with it for a little while, all in my backpack, and I just had no idea how to even, manage money, invest money, or anything. Fortunately, I started off with a friend that called me, and he was able to connect me with a financial advisor. I got a financial advisor, and which is very typical for professional athletes to, get drafted, or you play your first season, or you get some type of money, and then you go and put it in the bank and then ask for help because you have no idea what you're doing.
But in the meantime, it's just nothing.
Stay there in
Yeah,
cash.
okay.
And so hopefully you find a financial advisor. So I got one, right? That was before the season started, my rookie year. I just thought, wow, I'm just going to focus on football because that's what I'm doing to make money. And so I didn't really worry about it. Just had the financial advisor handle it. And we made it so I wouldn't have to worry about it. So I was in uni bonds, and I, was getting 3%, and which is great because it's not negative. I didn't lose anything. Everything that was there, I never really touched it. I pulled out a little bit, right, to live on. But other than that, I wasn't really touching this money.
Did you put all of the money in muni bonds, or did you leave some as a safety net, or a little bit that's liquid that you knew you'd have to live on?
I live off, I had that in built in, but I didn't really know about it or think about like how to grow my money. But I didn't realize that I could grow it faster while I played. And for me, that's where it really changed. But before that, I'm talking to my teammates and about the different things that they're doing with their money. And I felt like, there were some really hard choices and decisions made by the players. And then there were some that weren't so good. And it kind of was just a lack of education, where it's like, if you don't grow up with money and all of a sudden you're given all this money, like, what do you do with it? And so, that was very common. And so it's like, okay, well, how do I handle my money when it comes to, investing? But then I also want to help my family. How much is too much helping my family? Am I losing too much from helping people out that I can't grow it in a way that can set up my family for the future? And because you just have to handle all this, and it makes it tough for athletes. And so I think for me, I started to learn, you know what? I don't know a lot about certain areas. I want to be in these areas. I know they're good areas, like real estate, right? And I realized I need to find someone and talk to someone that I can trust that can, manage this for me while I play. I can't be a full-time real estate, management, person while I'm playing. That's why it was really neat when we met and we started talking, and you were sharing with me, okay, this is why real estate, plays a key piece. But maybe before that, would you be willing to like share, like if you got drafted and you got a paycheck, like a check written to you, like what kind of portfolio would you even do? Like if you could, as a rookie, knowing that, okay, you're gonna play, after 4 years, you're gonna play maybe 10 years in the NFL. Like, how do you invest that money as a rookie?
Yeah, every person's situation could be different, right?
Yeah.
Because you really don't know your tenure and duration in the NFL or whatever sport you may be playing. And so it's a little bit difficult to plan long term because you're just trying to the cut, and you're trying to stay in the league as long as you can and earn the big bucks while you can. But obviously things changed a lot for you too, because in the beginning I wasn't sure what to do, and now you're investing in a lot of different ways, including real estate, and I'm excited to talk about that with you more. But yeah, it is unique. I think a lot of times it's difficult because you're wanting to you know the people you can trust who knew you before the big paydays started to happen, right? They're the best people to give you the advice on what would be the best thing to do. And it's a little easier for me to look at it and say it's the best thing to do, but I think I can share some ideas of what I would say are best practices. But I would argue still that it's good to get lots of opinions, and you did that, right?
I did that.
You talked to a lot of people, and you asked a lot of questions, and you tried to teach yourself in the off season or when there was time for you to acquire more information and knowledge. And you and I sat down several times before.
We'll have to go through that about the vetting process. Because it is like, as a player, but then also from your side, where you're trying to help guys invest, like, and it's very common. And I think that's an important thing to know as an athlete, like to vet people multiple times.
Yeah.
And you probably handle it all the time.
Yeah.
So it's not a weird thing.
Honestly, it probably would have been scary if we sat down once and had writing a big check, right? It's good that you wanted to do your due diligence and you wanted to understand other asset classes and how that compared to real estate and the type of real estate even that Harris Investment Group does specifically versus other types of real estate that we can talk about. But no, I'm glad that you did. And that's what I would recommend is that you should talk to trusted people. Don't limit it to that. You need to find experts, wealth advisors, financial planners, who can look at it from a broad's eye view and say, you know, let's look at what you think the duration of time that you're going to be in the NFL, and let's set aside money today so it can last long term for you. And right now, where you're earning strong income, you probably don't need income focused investments. You probably, because you're young, can go more growth focused.
Yeah, and I wish I would have done that a little bit earlier. You know, especially with real estate and the growth focus. I wish I would have put more capital to real estate earlier, because even within real estate, it's a very, you know, has very strong returns, and you can have a strong, consistent holding within your portfolio. I think that's important, but maybe scoot a little closer.
I want to talk about that, but I want to say this real quick first too. When you're building a portfolio, what's standard in the industry is to set aside the money for taxes, set a certain reserve, emergency fund reserve that you can access that's liquid and isn't going to be put at risk, and then try to put to work in a diversified portfolio. And when you're young, it should be more growth focused. And so that could be stocks, mutual funds, you know, it could be a private equity, venture capital type play. Real estate as an alternative asset can also be a great growth investment. It's probably my preferred, even though I invest in all the different asset classes as well. And I'll get to why I think that. But one thing I think that's important to understand that I learned is that most wealth advisors look at what's remaining of your paycheck and of your wealth that you have after taxes. And I learned that you can actually assess it before taxes, making the right decisions with the money. You can reduce your tax burden.
Which is huge for professional athletes.
Well, right.
Because you don't even think about that. Like, okay, wait, I'm high income earner, I'm W-2. So I'm getting taxed where I play. And so sometimes you get hit with higher taxes because you're playing in certain areas like California, when, you know, maybe you wish you were playing more in like Florida or something. But I mean, it's like, you don't think about that as an athlete, and you don't realize how much money you're giving away, but that you actually could put to work.
And many of you probably already understand this, but playing in California where there's 11, 12 income, where Florida is no state taxes, makes a big difference of what you get to keep of that money after state and federal taxes. And so in California, that's almost 50 cents on the dollar that you give to the IRS before you get to keep the remaining amount. And so you get $1 million or whatever it is, right? And you're only keeping 500K of it.
That's it.
That is disappointing, right?
Maybe you still have to pay your agent if you have an agent.
Exactly.
Unless you're like Lamar, really smart. I didn't have to pay an agent, but you have to pay your agent. So now you're walking home with about 37%.
Nowhere near as much as what it seemed like. And then you still have your basic living expenses and things that you perhaps want to enjoy because you've worked really hard to get to that point, right? And so that money can go quickly. And as we know, statistics show that not many people remain in the league 3 years or longer. And if that's all that you're having that you can keep for only a few years of time, really you're not walking away from the career with any meaningful wealth that's going to help you put yourself in a path for a nice lifestyle thereafter, right? Money during the time that you can earn those bigger bucks is so critical and important. And I think you have to take the tax incentive to play when deciding these things. And I wouldn't have known this earlier on, but I learned this along the way. And so I think what I would say then is, if you can keep and look at the full $1 million amount in this example we just said, instead of $500,000, it could make a big difference, right? And a lot of times wealth management, they're just looking at the 500 or 360K. Once the agent, once the taxes and state and federal, then we're trying to figure out how much to put in reserve, how much to then you could invest. Let's give you I'm going to give you an example of some things that we do when we work with
Yeah,
potentially an athlete or business owner, doctor, dentist, chiropractor, whatever it may be, right?
yeah,
We want to look to see if there's a possible way to utilize the amazing tax benefits and tax credits of real estate and utilize it against one's strong income, especially if they're W-2, because there's so few tax benefits and tax deductions that you can take on a W-2 income earner.
yeah.
So before discussing the real estate, putting money into your 401k, right? You NFL, they've got a 401k
Yeah,
plan.
uh-huh.
I think they match.
Max it every
Max
time.
it out.
Yeah,
To take the full benefit of reducing your tax burden. So all of a sudden you go from $1 million to 900 and whatever I think it's 23,000 this year, $22,000 on a 401k. Then they have some other ways for it to go higher than that. You can do a
Yeah.
traditional Roth IRA as well to get a little bit more. Well, that's no longer taxable. And if you're doing a Roth, whatever principal that you put in, you can access that money without penalties and without taxes later. And so
smart.
I'll circle back to that, but
Yeah,
looking for those tax benefits, and 401ks I think are a great way. You'll be limited to what the 401k can allow. But it's a great diversification tool from what maybe I'm going to share with what you could do in real estate. One thing that's so cool is when you buy a piece of property and you have the ability to use leverage or have the bank finance the property for you. You and I did this. We could
Yeah.
go buy a $2 million, a piece of property and let the bank put up $1.5 million. And you and I put up the other $500,000 of equity.
mhm,
Well, the IRS looks at the total value that you paid on the property of 2 million, and they give you a tax benefit and a tax deduction on that.
yeah,
Well, in some cases, since 2017, it's allowed investors on multifamily to get up to $500,000 or $600,000 of first year called bonus depreciation loss benefit.
yeah,
What that means is you get a phantom deduction that's not real. It's a non-cash expense, but you can use that loss against any passive income sources that you have. So cash
Okay, yeah.
flow, maybe if you made a private equity investment, you could use those losses against those types of income sources. But in some cases, if you're considered active in the business of real
This
estate,
is important. This is really important. I want
It's-
everyone to
it's a
understand
game
this.
changer.
Yeah, this is the game changer right here.
this is where real estate most attractive asset class. If it wasn't already, I mean, real estate's great for so many ways, but when you can use tax shelter vehicle, it can become a very meaningful return. And so this phantom loss of $600,000, if you can qualify as an active real estate professional on your tax return, either you yourself or your spouse, if you're married, either of you can now qualify to have that phantom loss be an active loss. So typically depreciation's passive, which means it can only shelter passive income.
Mhm.
But if it's considered active, an active loss, income sources,
That's huge.
W-2 wages,
So my
NFL,
NFL income could be sheltered.
capital gains from the sale of business, passive income sources, cash flow from real estate, all income sources on the tax return can now utilize this loss to help offset the tax liability.
Wow.
So imagine making that $1 million a year and being required to pay, in the example we gave of, say, $500,000 between federal and state.
Mhm.
But because of an active loss that you and I made, where we generated a $600,000 loss, that $600,000 loss against your $1 million taxable income reduces you now to only a $400,000 taxable income before the other deductions that you 401k, right?
Yeah, wow.
And so all of a sudden, the $1 million of income may only show after all other deductions, say 200 or 250,000. And what happens, and you know this, Bronson, but we're in a progressive tax system. Every dollar that you make marginally could be taxed at a higher rate. And when you make $1 million, you're in the highest tax rate.
Yeah,
And so by getting this phantom loss against the highest tax rate gives you the biggest tax savings
yeah,
benefit.
the biggest.
And we
Wow.
could just say 40% could be higher.
Yeah.
Obviously in California or other states, it is much higher. But let's just say 40%, a $600,000 loss for a top income earner is a $240,000 tax savings benefit.
Yeah,
A $600,000 loss times 40% is 240 grand. And so
Mhm.
instead of giving 240 grand to the IRS every single year,
you,
you keep that money.
mhm.
And if you're smart with it, you invest it in more assets. You grow your wealth
A lot
so
faster.
much faster than
Yeah.
if you were paying everything to the IRS and to
Yeah.
the agent. And
That's a big mental shift.
It is.
Honestly, I'm just sitting here as the athlete, and I was that athlete sitting, listening to you speak and bringing in people. And I think the best thing about it is when I first learned this, it was, okay, let me talk to my CPA. Let me talk to my financial advisor. Let me talk to some other people I know that own real estate. In fact, other players that own real estate. And they all said, yes, like this is how it works. And for me, I was just like blown away. And it was just, it's amazing what real estate can do. But it's, that's one of my big tips for anyone that receives an investment or a deal. It's like, if it feels like, wow, I definitely need to learn more, then go and learn more from other people that will then go and vet what you're learning. Like that's what I did in that situation when I first learned about this and just real estate in general, because you get pitched all the time. So it's like hearing something, you got to go and vet it. And that's the main thing. I think like you think as an NFL player or any pro athlete, is that okay to go do that? It's like, yes, you have to go do that.
Yeah.
So that's why when you're telling me this as an athlete, I'm sitting there, oh, is this real? Like, can this really be? It's like, yes. Yeah. I remember seeing it on my tax stuff. I was like, whoa.
I've never asked you this, but I'm curious what you'd say. I'm the founder of Harris Investment Group. Yes, we raise capital from lots of investors, pull that capital and go into a lot of real estate projects where we're trying to generate a meaningful return for our investors and a tax savings benefit. And I think we have a great track record of success of doing that. But when you met me, I think you really met me more in the framework of Jason's a real estate investor, because I was at the time. But my passion has always been real estate, and that's what's really made me the most wealth to own Harris Investment Group and to now help lots of investors. So my question is, did you invest? I mean, you chose to eventually do an investment together, right? Was that because of my track record and background as a real estate investor, or because of what I knew as a financial advisor of all asset classes? And maybe it's both, but I'm just curious, what made you eventually decide to invest?
For me, a few things, but on that particular point, it was, I loved how you made in real estate. That was your background. You were just passionate about it and you were all in and you were leading that charge. You invest time, money into the deals as well, which I think is really important. So you have skin in the game. It's not like oh, I'm the only one with skin in the game. It's like, no, you do too. And
let's use your money.
Go ahead. No, now I would say go ahead. No, first, you're right. Financial aspect, but I really did enjoy the fact that you knew other asset classes. I felt comfortable. I got to the point where I felt comfortable, and eventually I remember sharing that everything with you, and you telling me, well, maybe you should look at this and do this. But I also, what made me move on is I remember when we talked, I think it was like the 7th or 8th time, and you're like, well, I think we got to close on this. Like, I think we're gonna maybe, like, if you don't come in, there's a list of, I think it was like a dentist or doctors that want to come in here. And I was like, I definitely should. But I already vetted you at that point and done everything. It was just, and I loved how you were like willing to teach me. That was probably the biggest thing for me personally, was when I asked, when I get into, like, we get into this, are you gonna be willing to teach me along the way? And that education piece is huge, which I think everyone, when investing, I mean, you go back, I mean, this is some great advice from some of the greatest investors in history, is like, you got to know what you're investing in, like, know it. And so for me, I felt like I knew it, and going through the process of the value add strategy, where you're buying something and fixing it up, and you're getting, your subcontractors are in there working, and I just love being able to learn about it and be taught that education piece, because it just reinforced why real estate is such a great asset class, because you're knowing before you're going into that situation. Which I love that. Whereas, like, I'm hoping and you feel good about it, but it's like, do you really know? Like,
There's
you know?
less control that you have. So interesting. Thank you. I appreciate you sharing that, because I am an active operator. I love and am passionate about real estate because it's blessed my life in a meaningful way. I never imagined to be where I am today financially, and a big reason for that is the real estate returns that I've been able to achieve over compounding in time.
Yeah.
And also the tax shelter benefits. As my income's grown significantly, I've been able to shelter a lot of that income because of my real estate investing, which has also allowed me to continue to diversify my assets. I don't think that real estate is the only investment that you should invest in. I believe in diversification, and I've diversified from the beginning. I talked about my early years at Pizza Hut. I was investing in mutual funds. I didn't know anything better, but it was growing for me. My little $8,000, $10,000 account. But to me, I saw it compounding and working for me. Point I'm making is, as my real estate investment became my tax shelter strategy, I knew how many dollars I needed to invest annually. I knew that if I could invest $500,000 into this project, it could generate enough depreciation loss for that year to shelter all or most of my tax liability. So that at the end of the year, I was writing, a very small check, if anything, to the IRS legally, because I was generating enough of these phantom losses. And so it became a part of my strategy to understand with my CPA how much money I was going to pay in tax, and then to know what would I need to do in way of my real estate investments or 401k I qualify for to get my total tax liability to zero if possible, right?
Yeah, that's the goal, get it all the way down.
And Bronson, it's possible to go negative. And I think you may know this, but there's been the last few years where I start out with a negative $5 million loss for the year. I can make $5 million that year and know I won't pay any taxes because
that's a good feeling.
It's called a net operating loss, an NOL. You don't lose it, it carries forward. And so when you're buying a real estate investment project and you generate that meaningful loss, if you have more phantom loss than you do income that year, you can carry the remaining loss forward for the future.
Okay, so here's okay. So that's huge. But it makes me think, like, if I'm a professional athlete and I'm starting out and I have large lumps, I actually know in my contract how much I'm gonna make, right? If I'm on the team, and I could plan that out. I could figure out how much do I need to invest now, and then the next year and the next year, and keep building it so it carries forward all the way. So I could get to that, and you've had so much carried forward that when you sign that, you're able to not pay a lot of tax on it.
And if you can't figure it out, your CPA or tax professional at least should be able to, right?
Yeah.
What your tax burden is going to look like for that year, most likely based on your W-2 wage and any other income sources that you have. And so there can be some planning involved to understand, what could I do then with this wealth or money I have to maximize my tax savings benefit, earn that this asset could generate for me. And so with our real estate deals, most of what we do is value add multifamily, meaning we're buying distressed properties that have some type of higher and better use that it's not currently achieving. So usually it's a 1960s, 70s, 80s type property, mostly apartment complexes of 100 to 300 units in size, that the manager's not doing a good job of operating. Maybe the owner doesn't have capital to put into the property, and so he keeps his rents artificially low. It could be a number of things, but we're going to come in and create our business plan from where it is to a much higher net operating income post renovations, better management, and abilities to improve cash flow. And as we do that over typically a 2 to maybe 3 year timeline, we're able to reposition the property from a underperforming, distressed, ugly property to hopefully a rebranded, very nice, modern, and newer property that tenants are happy about their place that they live, that they're willing to pay a lot more for it. And there's added amenities that we're adding, and storage units and covered parking and a doggy park and whatever it may be, right? And so that then allows us to generate these meaningful tax loss benefits some cash flow on the tail end when we stabilize the property,
Mhm.
and a very nice payday when we sell the property.
Yeah,
And if you want, you can roll it in a 1031 exchange and not even pay any taxes on the sale.
so imagine doing that your first year. What, and then all the way till you're done playing.
What year were
Just
you in?
1031.
when you did it?
I was in year 3,
Year 3.
but I wish I would have been in year 1,
Yeah.
right? 1031ing all the time, but I'm a passive investor. So it's happening. I'm getting the tax benefits. It's happening, but I don't have to worry about it because I'm doing what I do best, right? Yeah, I think that's like a unique piece that is so important, because like if you want to make those big moves, it takes big planning.
Yeah.
And so
Yeah.
you have to make sure you have a team in place, or like when I think about it, I'm like, okay, I gotta have, the captain of my real estate. I gotta have, the captain of my financial planning. And I think like the biggest thing for me, really good teachers and willing to teach me these things, because I don't know anything about them.
Yeah.
And so I think, now it's like, oh my gosh, multifamily is a great investment, because before you go into it, you know what you're going to fix up. And so how much you're going to be able to charge once you fix that up.
Mhm.
And
Yeah.
and those are all things, like you were saying, things that you control. And after investing, that's why people love real estate.
Yeah.
So
If I may add to that too, real estate, it's a hard asset. It's a physical asset. It's tangible. It's real. It's not going anywhere. And it provides a real purpose for housing US citizens, Americans here. And so because of that, it's not like a paper asset of a stock or a bond or crypto or whatever it may be, where that doesn't have a real benefit if something goes wrong with the company. Like
Yeah.
when things go wrong, you still have some control of the performance of the building. Where we're coming in and improving the value, I can impact the growth of the investment, where my stock investments, I have very little impact to the growth,
Yeah.
right? And so I love real estate for those reasons, but also it's one of the few assets that you can utilize leverage. I can have the bank put up 75% of their money, but keep 100% of the benefit by only putting 25% down in my own.
And by benefit,
Yeah.
all your return that you get when that happens.
Yeah, take the $2 million example we were given. You and I put 200K into it after we close. So we bought it with 500K.
Mhm.
We used the bank's money of $1.5 million.
Mhm.
With a bridge lender, they'll also finance your renovation budget of the 200K. Our basis is now 2.2 million. But if we then turn around and sell the property for 3.2 million, I'm making this up, but that's
Yeah.
kind of what you and I did.
Yeah.
That's pretty close to our numbers.
Yeah.
And so now all of a sudden you have a net profit of $1 million.
Yeah.
There'd be some fees to the brokers for closing costs, right? But
Mhm.
that 3.2 minus 2.2 is our profit. So you get $1 million, all the upside plus our initial 500K down that we created, right?
Yeah.
We get the tax savings benefit we were talking about,
Yeah.
potentially some cash flow and principal reduction as we paid our mortgage.
Mhm.
But when we close on it, the loan gets paid off and we get the remaining amount. And so
Wow.
all the bank got was their 4, 5, 6, 7% interest rate, whatever that rate would have been. And we keep all the upside,
Yeah.
and so for us, it ended up being almost 100% return on investment.
Yeah.
Before the
Because I'm thinking how the bank, everyone says, oh man, the bank's taking your money. And I'm like, well, if you do real estate, it's like taking their money, like that's how it reverses it. It shifts the table.
Beautiful,
So-
because you can't go to the bank and say, hey, will you leverage 75% against Apple shares of stock for
Yeah.
this crypto coin? I know it's gonna go big.
Yeah.
Will you put up your money? I mean, no way will they do that.
No,
But
yeah.
But real estate has less risk and it's less volatile, and you can control more of the outcome. That's why banks are willing to give you significant leverage, and yet you get to keep all the benefits and the tax savings on it. Not everyone can qualify for this meaningful tax credit. I mean, actually anyone can. It's just maybe not everyone can meet the requirement to take the
Mhm.
loss as an active loss. And that's something that you'd want to discuss with your CPA or with Harris Investment Group, where we could help put you in contact with professionals. But the real estate example I gave was a multifamily project. If you bought $2 million piece of property with $500,000 down, maybe you generate a $500,000 to $600,000 loss. That's on multifamily. If you and I, Bronson, had gone and bought a gas station or a truck stop, we could possibly generate a $1.7 million loss, or something
Way
so
bigger.
much higher.
Yeah.
And so $100,000 investment, call $500,000 to $600,000, and you generate a $1.7 million loss in the first year, and you can use that loss.
That's what I want to do as a rookie, probably.
I mean,
Go into something like that and then gather that first, and then 1031 it into multifamily as we go. But at least I gather that big tax.
That would be
benefit
only
upfront.
if you're qualifying as a real estate professional and you know that you can get the tax savings.
Yeah.
Because $1.7, $1.6 million on a 40% tax rate that someone may be in, that's $640,000 of tax savings.
Crazy.
Bronson, you put up $600K to buy the $2 million property, and it generates you $640,000 of actual savings. That means the equity you invested has already been returned to you before the asset itself performs.
That's crazy.
Appreciation, cash flow, principal reduction, that's all gravy. You have all your money back. That's like the velocity of money concept, where you're able to invest in an asset, retain the asset, and let it grow and compound for you, and then use the money to go and buy other assets to continue to grow. And that's a best case scenario of how you could utilize the tax incentive. But it's possible.
No, it is.
I do it.
Totally see
We do it with investors.
Yeah.
You've seen that.
Yeah.
And so it is very much possible. If you're not generating, and again, sometimes, just so it's clear, we usually are looking for that as a 2 to 3 year play, where then we'll sell the gas station, we'll generate some cash flow while we're managing the property, and then sell it in a 1031 exchange, which when you sell it, you then don't have to recapture or pay taxes on capital gains if you use a 1031, because then you can take the equity, your initial $500,000 or $600,000 plus any profit that you've made on the sale, and roll it into another asset type, which we typically for the long term prefer to be in multifamily. There's stronger return potential in multifamily, less risk, and so we'd rather less risk, higher returns in the value add approach. And so we may use the truck stop for its meaningful tax benefit for those who can utilize the loss against W-2 income. And then 2-3 years later, roll it into multifamily, where we can start compounding returns. Because of real estate being so incredible, you could generate the real estate to be an income focus for you, where you're trying to achieve a certain cash on cash return, which means, say you invested $600K and you're hoping for an 8% return on that annually. That's $48,000 a year. Well, we can generate those types of cash flows in the right type of property. But more times than not, when you're young and you have strong income and you don't need the income to live on, you'd rather your money just be working as hard as it can, you're probably investing more for growth focus. And if growth focus is what you're aiming for, then the value add approach could be more meaningful. The fourth appreciation. That's where you turn the properties from a $10 million deal to a $17 million deal in a few years after you renovate and improve them. And so that's where then when you sell it, you've significantly increased the value of your equity, and you can take it back and utilize it in other assets, or compound it and roll it and do another one. And we look for opportunities to continue to drive strongest return potential with the equity. And why I think a lot of investors work with us too is because the return potential is so strong. But I think we also do we have a more focus on helping our investors from a tax sensitivity or tax strategy as well, to help them create the wealth plan that they're hoping to do to generate now and into the future. So
that's so cool. As you were talking about multifamily lowering risk, it just makes me think. I think a lot of athletes and investors are curious, like, okay, so what about, how do you navigate the real estate future as far as the different economic things that are going on? And it's a common question, I think, right now, because I feel like a lot of people are interested to see like what different takes are so yeah, I guess what would be like your take on that, and how does multifamily fit, because it is unique within the real estate kind of umbrella.
Yeah.
So
Well, real fast on the truck stops and gas station, we are trying to see a 6 or higher. If we can do that, we know that we're still generating a meaningful cash flow and the tax losses that our investor expects, and then we can roll it later. And so we're always getting fixed interest rate debt.
yeah, okay.
And so, if we're taking on, say, 6.5% interest rate, we need to have a 8-9% or better cap rate, so we can generate a big enough income stream off the equity that we invested. And so that's the strategy there. And more times than not, we're looking for an opportunity to buy a 8 or 9 cap gas station and sell it for 100 bips lower. And there's different ways that we can do that, right? And we look for those deals. On the multifamily side, it is challenging right now. Interest rates are, and maybe where they could go. I think that we'll start seeing a softening in rates towards the beginning of next year. We just got another update that the Fed could raise rates another 2 times, 50 bips total, towards the end of the year. But again, seeing lower rates, into 2024. But with that said, that can always change. You never know. Whatever they say, no one really knows. Won't actually happen. But with multifamily right now, because rates are so high, what's happening in the economy is first-time buyers, instead of buying, they're feeling like it's a better time for them to rent and continue to try to save and put money away for a future purchase. And so they're either being priced out of the market because they can't afford to buy, or they're choosing not to buy because interest rates and debt is too high. And what does that mean? That means there's an increase to the renter pool that want to rent or have to rent. And with limited supply being there, what then happens to rent rates? Rent rates have to go up. Which is kind of
happening. I kind of feel like they're going up right now, even like,
especially in the markets that we look to invest in. We're seeing we're in Louisville and Kansas City and some of these markets, and so, but we're seeing much higher rent we're able to attain than what we thought we would be able to achieve. And so where we're catering already to the lower end of the market rent range, meaning if you have Class A up here that's brand new, nice assets, that's going to demand the highest rent rate of the rent range.
Yes, I see what you're saying.
But Class D and Class C, that's going to be the bottom, right?
Yeah, everything's going to jump, but it's like Class C.
And we're in the Class C. Yeah, we're Class C, not D, but we're in Class C, which is well below average. And so that's what we take over initially, because they're artificially low rents, but we're going to come in and improve it. So once we've improved it, increased the value of the property, where tenants have ownership pride, they'll be willing to pay more for their nicer, newer property and the exterior amenities and whatever else that we've maybe added. And that's going to push us maybe to the average, or maybe even slightly above, but most likely average of still the rent range. Makes us where we're in a safer spot with the real estate. And because of the economic environment, that rent rates being pushed up typically pushes from the bottom. And so we're seeing on our asset class C, a much bigger jump in rent range, where we thought we could push rents after renovation, say $150 or $200. We may be getting $300 or even $400 more after we renovate the property.
That's great. Wow.
So despite the challenges of interest rates being higher, fortunately, as value add investors, we can take a current property and the financials thereof and go from a $500,000, say, a year net operating income, and push it to $1 million a year or more.
That's crazy.
With some nice capital improvements and better management. And when we go to stabilize the property, where we're refinancing it or selling it, we're selling it double the amount of income that it was producing before. And so despite interest rates being higher for a future buyer or for us, we're able to offset that interest rate expense some because of or maybe all, I guess, with significantly higher rent rates that we're able to achieve.
Oh, I see what you're saying. Yeah, it makes sense, because I'm seeing it even right now. And I see how it kind of, as rent rates go up, interest rates are going up. I can see how, the value add space, it creates a great opportunity over across all real estate.
I mean, it's
opportunities.
tough to find right now properties that cash flow when you have to borrow at 6.5 or 7% interest rates,
Yeah.
right?
Mhm.
I mean, you put 25 to 35% down, so you're only borrowing 65 to 75% against the money. And so if you're borrowing at 7% and its cap rate 7%, there may still be some cash flow only because of the equity that you paid off, because
Yeah.
you're not borrowing the full 100%.
Okay.
But that's often not going to happen where you're not collecting C could be hit or something goes out. And so more time than not, Bronson, you've got to be able to, buy, so we're not buying it for that. We're buying it for its future potential
Yes.
cap rate or future potential cash flow. And so
Mhm.
we're taking the property, like I said, maybe we're a $500,000 a year income represents a 7 cap type
Mhm.
price, which I think would be, if I'm doing my math right, something like a $9 million type purchase. 9 million, and it generates $500,000 a year of net income after all expenses. That's about a 7 cap
Mhm.
type purchase price, and pushing it up to $1 million a year.
Yeah.
If someone were to pay, a 7 cap for $1 million a year property, they would now pay $14 million
Yeah.
for that. And so
Yeah.
we've increased the value. Actually, it should be 18. I must have done something with my math. But essentially, you take net operating income divided by the cap rate of that market, and that'll get you the new value. And us increasing the income by two times of what it was,
Yeah.
we're increasing the value essentially 2 times where it was.
Yeah.
Interest rates go up quite a bit, which they have. But
Yeah.
again, you're still going to see some nice, meaningful profits because of the value add strategy.
Yeah.
That's why I like it so much, is you have some control in your ability to improve the returns of your money
Mhm.
instead of just throwing money at a real estate project and hoping over time, and you generally over time,
Mhm.
you can raise the rents organically through natural rent rate because of inflation
Yeah.
and natural appreciation. But the returns on something like that versus value add is significantly lower.
Yeah. Okay. That's awesome.
That was a lot of meat and heavy,
No, yeah.
but
I
put that there.
I'm like, okay, let's say you're sitting with an athlete right now, or someone that's sitting on, some money. It's dry powder. They're sitting on it right now. I know there's a couple of deals that that you guys have, and maybe you could share like just a little bit about them. Then, like, what do you love about them? Like these specific deals that are available for people right now. I'm curious.
Yeah, no, thank you. First, you want to make sure you've set aside an emergency fund reserve.
Yeah.
You want to talk to a tax professional and see what your tax liability is, and is there ways to reduce the tax liability? If you don't have a good CPA, reach out to us. Contact at harrisinvestmentgroup.com. Trusted CPAs and professionals and firms that we've vetted that we know are really good when it comes to business owners, real estate investors, as well as just strong income earners that have meaningful tax liability. So happy to help with that.
Mhm.
But once you've kind of assessed what you have available to invest and maybe where you'd want to invest that, then it comes time to like vetting out, if real estate's one of those options, what amount you would do and where you'd put it. And so, we can help discuss that. But 2 that we have right now, and really we're coming to the end of one where we won't have much capacity, is the launch portfolio.
Mhm.
And I'm now just putting $500,000 more into it. That means I believe in it.
Yeah.
But what I like so much about it, it is in Louisville. We already own a property out there, almost 300 units. And I was out there maybe 3 weeks ago, walking and touring our existing project
Yeah.
that we underwrote as a value add, and now we're in the value add process of fixing up and improving the units. Well, like I said, the classic units that haven't been renovated, we're getting $750, $800, but the goal is to fix them up, improve them, and try to get more post renovation. $750, you renovate it, and then you're going to get $1,000 a month.
Wow.
We were there a few weeks ago, and this particular unit was a little bit different format. We did a $15,000 renovation than the typical $11,000. So it was a nice one.
Mhm.
But it went from $750 to $1,200.
Whoa.
$200 more than what we thought we were going to get.
Wow.
And you times $200 more times 300 units.
Yeah.
That's $60,000 a month.
It's a great deal.
$720,000 a year. And when you're value add and you're looking to sell it, if you could generate even 500,000 more a year. 720 would have been the real example on that type of jump. But 500,000 in a market % cap rate, a market, that's almost 17 times more of what you're generating in income. And so $8.5 million increase to the property value when we're getting those types of rent rate increases. And honestly, if it was 700,000, you know, you're looking more at $12 million increase. I mean, unbelievable increase. Now, rates may have an impact to keep it from going that high. We're sitting in a great spot. And Launch is in the same neighborhood. In fact, it's a portfolio of properties that are intertwined with our other property that we bought last year.
Wow, so you own a property right there, and then just down the street, you own another one.
It's not even down the street, it's in the neighborhood.
It's
They're
in the
right there
neighborhood.
together, intermixed.
So you already know what's going on there.
We have lots of confidence in our pro forma of what we're going to be able to expect post renovation, because we already own a lot of properties in this community, in that neighborhood. A controlled HOA. I do not like HOAs. I don't recommend HOAs. So the best part about this is we're just HOA because now we're the majority owner of it's about 930 apartments. And we'll own, no, it's 900 and we own 530 of those apartments. And so we can actually dissolve the HOA. And why is that so nice? Well, when we go to sell these properties, a future buyer now, because it's not an HOA, qualifies for superior financing terms. You can get agency, Fannie and Freddie type debt and other types of good debt structures that have preferred terms, lower interest rates than what we had to do going into it. The numbers made sense us going in, right? But it makes it look even what we're going to be able to exit on the price, because we know the buyers are going to get better financing. And so that's not even in the pro forma. That's just an added benefit to the Launch. And so I love that one. I've bought a lot of portfolio type properties like this, and we've been able to sell those using the comparable analysis approach and not completely income approach. You don't have to understand that, but really it just means that we have different ways to prove that they're worth more than what maybe an initial buyer would say they are. So we've got such strong mission to push for a higher amount for our properties. So that's one. And then another pretty cool deal is an actual truck stop, what we were kind of talking about before. Center branded truck stop with an operator who has 17 TA centers, and they're building 3 new ones at 30 to 35 million. That's their cost to build these giant truck stop TA centers. And this one's going to be a conversion of a current truck stop that's an off-brand to a TA center, but the total cost is 18 million versus the 30 or 35, which puts us in a position to be able to resell the TA center after we own it and close it for a much stronger cap rate or price than what our costs. And it's a 9 cap deal. It's with an operator that we really enjoy. They've done a good job. We've done 2 other deals with them, and they've outperformed their pro forma targets in working with them. And so when you buy a truck stop, unlike multifamily, we're the operators. With a truck stop, we want to find good operators and then have them do a triple net lease with us, where they're paying us a lease each month and we just own the property. And so we want to make sure they're very profitable, that they're making enough income after all expenses to still pay us the lease and have enough profit that keeps them motivated and incentivized to keep going. And they've done a good job of that. And so again, the TA center, we're expecting probably a 1.8 to 1 depreciation ratio. That means if you invest $500,000, you could expect probably a $900,000 tax loss benefit. We're going to try to get 2 to 1, but we'll see if that works out. So so 500K could be $1 million loss, right?
Which is great, but before it even performs.
Exactly. That's the tax savings, and that has nothing to do with the actual return. Those we look at separately of what we try to hit for our investor base. So
geez, it's 4 o'clock right now, but to me it's just crazy how
4 o'clock. Sorry, that was
I think it went fast. But it just makes me think about how important it is, like as an athlete, there's just a lot that you don't know about in the investment space, and you need to find people that know these things and are willing to help you learn about them, so you can feel confident going in them. You know, you trust the person, you trust what they're going into, what asset class you've learned about it, and you're not going to know everything, but you're learning, and they're willing to teach you. I think that's huge. And then I think just with any investment, because you're going from not knowing a whole lot about investing to now here's a lot of money you're investing. It's important to, you know, have conversations about this. Like, not a lot of people have enough conversations about investing from a pro athlete space. Just normalize that, because you're going to be facing it anyways. So I think that's huge. And then my way of thinking about value add, honestly, from my athlete's perspective, is you're a rookie organization as a rookie, and you're playing. But every year, your value add is you go into practice, you're getting better. And then game, you get better your second year, you get better your third year, right? And then whenever that contract comes around, that second contract, you're actually worth more.
Exactly.
So you're literally doing the value add strategy.
That's an interesting analogy.
But, you know, and realizing, oh, now I am actually worth more. You know, for a team and organization. And you've proven your worth. You've proven your worth. For the last few years through value add. That's awesome. So I like that. No, but anyways, I don't know, maybe we could, do you want to take a few questions, or see if anyone has any questions? You can put it in the chat. I would even say to Bronson, just find a good wealth manager, a financial planner, and talk to many, you know, as you're trying to figure out what to do with this money. And at Harris Investment Group, we only get compensated when you invest in an actual project. And so if you want to utilize us as a resource, just someone to share your ideas and trying to get, you know, a plan in place, we're happy to take some time to share, you know, our best ideas that we have, and refer you to CPA groups that we work with that we think that do a good job and that we vetted. And you know, we've seen a lot of our investor base too, and they've referred, you know, they refer clients to us sometimes too. But you know, having to be a resource that doesn't cost any money, but we can share, you know, ideas there. So, well, maybe we can send. What's cool is that we recorded this, so whoever signed up, you will get a recording of this, and that way you can watch it and share it with anyone that you know. And but I mean, it's just such a valuable thing to know these strategies everybody should know these strategies, not just athletes, but everybody, because the compounding is real and it's valuable. And the younger you are, the more time you have at your advantage. And the sooner you start, the more and more experience that you'll gain and conviction of what this can mean for you long term. And I mean, it's just unbelievable in my 15-year journey of how much I've seen the compounding, you know, really accelerate. And you know, it's fun, and you've seen it yourself too. And you know, you get your own experience to look at. So anyhow, if you have any contact at harrisinvestmentgroup.com, leave your questions. Bronson, thank you. Appreciate you setting this up and going through that with us. And have a great day, guys. Thanks for your time. Thanks.